So nonprofit accounting pitfalls to avoid might not be the most riveting topic you'll hear all day, but I think it's an important one because if I give you a heads up on all these things today, when it comes time for your year end, you're just going to have smooth sailing and breeze right through it. So with that, we are going to jump right in to the first one, pledge accounting. So I know this isn't the most popular accounting standard because when a donor says to you, I'm going to give you $50,000 a year over the next 3 years, you don't get to record that revenue over 3 years. You have to record it all up front. So when someone pledges to give you money, at the time you get that pledge, you have to record the receivable and all the receivable and the entire amount of revenue all in the first year when you get that pledge. So that doesn't make you, I know with nonprofits, you don't want to show a bunch of revenue that you don't have the cash access to yet up front because that makes it harder to get, to look needy for other donors. But that's just how the accounting works. You have to record it all up front. And that is one of the common errors we do see, that people don't record that at 100% when you get it. But keep in mind that that's how the accounting rules are written. So the next one is in-kind contributions. So if you receive either donated goods or professional services, you want to be tracking those throughout the year. Rather than scrambling at year end to figure out what those amounts were. For professional services, it has to meet certain criteria in order to be recognized. It has to be a specialized service that you otherwise would have had to have paid for. So for example, if you have an attorney on your board and he helped you through a case and spent 100 hours in volunteer hours, you need to record that as legal expense, even if you didn't pay him anything. You have to record that as legal expense and contributed services. So keep that in mind and make sure you're tracking those hours so you're not scrambling at year end. And then donated goods. If you're receiving material amounts of goods throughout the year, figure out a system to track those so that, again, you're not scrambling at year end. Think about that as you go, because if they're material, you need to record them again as an expense and a revenue. So it doesn't affect your bottom line. It grosses up your statement of activities, but you do need to reflect those. Unrecorded interest in estates and trusts. So we've seen this not make its way to the balance sheet as an asset. If you are simply named as a beneficiary in someone's will, you don't get to record that. It has to be irrevocable. So when it's irrevocable, that means either the person has probably already passed or you're the beneficiary in what's called a charitable remainder trust or a charitable gift annuity or something along those lines. So if that's the case, if it's an irrevocable trust, not just named as a beneficiary in a will, you need to record that as an asset and it gets marked to fair value every reporting period. So you need to have a methodology to figure out what that fair value is at each balance sheet date and mark it to market. Okay, revenue recognition and classification errors. So first off, GAAP requires that we segregate earned income from contributed support. Earned income is what we call exchange transactions. So if you're doing a fee-for-service contract, that's earned income. That's going to be separate than contributed services that people are just giving you with nothing in return. And then furthermore, contributed support has to be broken down. So first we decide, is it conditional or unconditional? If it's conditional, we don't get to record it at all. So conditional means it's conditional upon something happening that has not yet happened. So if I win the lotto, I'm going to give you $1 million. Well, we can't record that because what if I don't win the lotto? You don't get the money. So until and unless I win the lotto, you don't record that $1 million. So first think conditional or unconditional. If it's unconditional, you get to record it. Then you have to decide, is it restricted or unrestricted? It can be restricted for time or purpose. So back to my original example on pledges, if I'm not going to get the money for 2 years, you're talking about money I'm getting next year and the year after, well, that's inherently restricted to time, right? I don't have access to that money yet. It might also be restricted to purpose. Somebody might say to you, well, I'm going to give you $100,000, but you have to use it to build a new theater for the school. Okay, well, that's restricted. So think first, conditional or unconditional. Has to be unconditional to be recognized, and then is it restricted or unrestricted? And that'll tell you what column it goes in. Separate accounts, separate columns, separate presentation on your statement of activities. There's also a new requirement this year for contributed non-financial assets to be shown on a separate line. So if you're getting donations of books or clothing or any kind of non-financial assets, starting this year with your June 30 year ends, you're going to need to show those on a separate line item for non-financial assets. Yes? How is that different than in kind? Well, in kind can be a service too. So you can have, yeah, as long as it's a non-financial asset. So somebody might, like back to the charitable remainder trust, that would be a financial asset. Non-financial assets have to be separated. So just make sure you can have, it's in kind, but it might be different than a financial asset that's in kind. So if somebody donates stock to you, that's a financial asset. It has to be separated than if somebody donates books, which is a non-financial asset. So yeah, they're both in kind, but the non-financial needs to be its own separate line item. So as you can see, this can get kind of complicated with all the different pieces, so please don't hesitate to reach out and ask us any questions as you're going through this. The next one we see is expenses recorded in the wrong period. So, everyone knows as you're getting to year end, you're trying to estimate what your accruals are. You might not have all your invoices in yet. So you know who your vendors are. Put it on your closing checklist. You should have a step for reaching out to your vendors. And if they can't get you a good year-end cutoff invoice, then ask them to give you an estimate, just so you can get an accrual on your books and get a good cutoff. Because if you don't, your net income is going to be overstated, your expenses are understated, and then your auditors come in and tell you you have an adjustment. So we want to avoid all that. So be reaching out to your vendors and get estimates on things you know are out there that haven't come in yet. So then functional expense allocation errors. So this already was an area that was prone to bias and error because it's kind of subjective when you have to allocate expenses for your statement of functional expenses. And ASU 2016-24 clarified some guidance on which expenses should be classified under program, management in general, or fundraising. So some common errors. So let's say you are attempting to secure fundraising. You would think, oh, well, I'm out there trying to get this fundraising from this governmental agency. That's fundraising expense, right? Well, not necessarily, because it depends on the type of money you're getting from that governmental agency. So if you are trying to get a grant for a fee-for-service contract from that governmental agency, that's going to go under management in general. But if you were trying to get a contribution from that very same governmental agency, that's going to be fundraising. So you really have to make sure you're tracking your CEO's time or your fundraiser, your business developer's time, to make sure you know who they're talking to and what and how much of their time is spent. Yes?
What would be the difference between a restricted donation and a grant for service?
So if it's an exchange contract, like a fee for service, I have to perform services in order to get that money. then that goes under management in general because it's not just a contribution. It's not really fundraising.
But if it's a restricted contribution, how does that?
Oh, if it's a restricted contribution, it's still fundraising, as long as it's a contribution, not a fee for service. Yeah. The accounting standard discusses a concept of direct conduct and direct supervision when determining whether certain shared expenses are allocated to either management in general, fundraising, or program. And so for a lot of organizations, this is going to put a lot more expenses under the management in general column. So on the next column here, examples of expenses that would be allocated to non-management in general. So if the CEO's time or their compensation, we're talking about a portion of their salary, right? If the CEO's time is spent directly supervising a program. So, for example, I'm on the board of Mariposa Women and Family Center. Our CEO is a psychologist, so sometimes she spends time directly on a program. That time would be program expense because she can work directly on the program. She can treat patients. That would be program expense. But the CEO's time cultivating donor relationships, that would be fundraising because you're specifically going out there talking to donors. Yes?
The CEO supervises the program directors. Is that direct?
So if it's direct supervision, yes. If it's an indirect allocation or HR type of things, then no. Which kind of gets us to the next column. The CEO's time spent on indirect supervision or management of the program, it can't be identified with a specific program, but say the CEO is just kind of indirectly managing the people and the resources, but it can't be assigned to a specific program. That is management in general. Human resources time. Management in general. Grant accounting. A lot of people used to put, if you're big enough to have a separate accountant just for your grants and your programs, a lot of people used to put that under program expense. It has to be management in general now because it's accounting. It's considered management in general. So a lot of these changes are going to put more in your management in general and a little less in your program, which I know donors don't necessarily like to see. And then the last thing to consider is disclosures. So when you do have shared expenses and you're allocating one expense over multiple columns, whether it's management in general, fundraising, or program, you need to disclose which specific expenses are being allocated and what the method is for that allocation in your notes. Okay? And that is the end of our nonprofit accounting pitfalls. Before I move into if you have accidentally, unknowingly tripped yourself into a single audit, are there any other questions on accounting pitfalls? Rick?
So you mentioned a CEO's time, right?
Yeah.
CEOs don't enter their time at the end of the day to say, I did this much
Right.
in program work, I did this much in terms of management work, and I did this much in terms of fundraising. So what are some ideas? How can a CEO allocate their time across those different functions?
So I think they're just, there's no hard and fast rule as to documentation, but I think if you have either a policies and procedures manual of what the responsibilities are, or maybe a matrix of percentages of where you spend your time documenting. I do specific program supervision. I spend approximately 10 hours a week doing this, and 20 hours a week doing this, and 10 hours a week going to events and fundraisers. That would be good to support what the CEO is doing. There's no hard and fast rule. I'm not going to say, well, you have to have it in this matrix or we're not going to accept it. I mean, as long as you have some kind of reasonable documentation and evidence of support, and these are the responsibilities, and those things do in fact qualify for fundraising or program, then I think that would be sufficient.
They actually, at the end of the fiscal year, they actually distribute a survey to their employees, and they ask their employees, okay, so for this last year, can you estimate where you spent your time? And they would have the different programs listed, then they would have management services, and they would have fundraising, and they would just distribute that survey to their employees every year. They'd take them in and they'd analyze them, compare them to last year, and that's how they would come up with their year-end allocations.
So if you do that, one, I would be careful that they know what those definitions are, because one employee's idea of fundraising might not be the other person's idea of fundraising, and we just talked about these little nuances that can really trip you up. So I would be a little careful that you get really specific if you're going to do that. And then also you want to make sure that that's in sync with their job responsibilities and they're not doing something that isn't really, well, you don't, that's not even part of your responsibility, so why are you checking that box? So I would just, that's a great idea. I'd just make sure you have parameters around it. Is a single audit in your future? So we've had a lot of new governmental programs in the last few years, as you all know, and a lot of organizations may have unknowingly and inadvertently tripped themselves into requiring a single audit. For those of you that don't know what a single audit is, it's an audit. In addition to your financial statement audit, they call it a single audit because it encompasses your financial statement audit along with an audit of your programs. More specifically, we report on internal controls over program compliance, internal controls over financial reporting, and then also it's program compliance, program controls, and internal controls over financial reporting. So like 3 extra reports in addition to your financial statement audit opinion. And it's all rolled up into one thing called a single audit, and it's under uniform guidance. And if you have $750,000 or more in it's called your CFA, it's your federal expenditures in 1 year, then you need a single audit. So it's not for all programs, it's certain government programs, federal, not state, not county. But you have to be careful because if you're getting state or county money, you could be a pass-through, so you have to look at the funding source. If it's federal funding, regardless of whether you're getting it directly from the federal government or through the state or county, if it's federal funding and it's $750,000 or more, you may have tripped yourself into a single audit. Yes?
If you get money from a private source, is it important to find out that private source's source of funds? Because we do have banks that get money, say, from the Federal Home Loan Bank, and then they pass that money on to us.
You should know where it's coming from.
And would we have to report it if we know that it's coming from a federal source?
So that's going to depend on the program. So I'm going to go through some programs right now because not all programs trip that requirement. So the largest 4 COVID federal programs all trip the requirement. The largest 4 are Coronavirus State and Local Fiscal Recovery Fund, Coronavirus Relief Fund, Education Stabilization Fund, and Provider Relief Fund. These are the largest 4 that came out of the last few years of COVID funding. And you can see in that far right column, are they subject to a single audit? Yes. So that means if you got this funding, it does count towards your $750,000. And it would, if all your federal programs added together, not one program of 750, but if all your programs added together get you to the 750,000 threshold, you will need a single audit. So this is just those first 4. Now these are some more common ones that you all have probably seen. The Shuttered Venue Operator Grant, yes, that does count towards your 750,000. The Emergency Rental Fund does, and it's also identified as higher risk, which I'll get back to that in a slide or two, but just keep that in mind. The PPP program and the Healthcare Enhancement Act do not count towards. Those are not going to trip a single audit. The Employee Retention Credit Program, no, that will not trip a single audit. Telehealth, yes. EIDL loans, no. and restaurant revitalization program, no. So this is just the tip of the iceberg, but I wanted to put some of the more common ones up here because these are some of the ones you all might have gotten. More than 10,000 new single audits are expected this year because of all these programs. That's a lot. There's a lot of people who are just kind of inadvertently, oops, now I need a single audit. So what programs are your auditors going to audit if you do have a single audit? This gets back to that higher risk designation that I mentioned a couple slides ago. So the way auditors determine which programs, because you might have 100 programs making up your 750,000. How do we determine which programs to zero in on and an audit is a little bit of a complicated calculation, but the first thing we do is we divide it between type A and type B programs. That's simply based on dollar amount, size. Once we do that, then we divide it between higher risk and lower risk. So of course, if you have a type A, which is larger, and it's deemed higher risk, that is 100% going to be audited. So type A, higher risk, will always be audited. So that's why I wanted to designate those on that first slide as which ones are going to be high risk and therefore more likely to be subject to audit. So the good news is the single audit due dates did get extended. So normally the due dates for a single audit are the earlier of 9 months after your balance sheet date or 30 days after your auditor issues their opinion. So if you are a June 30 year end and your auditor issues our opinion, you issue your financials on October 1st, you have 30 days from October 1st. If though it's not October 1st, you can issue them as late as March 31. March 31 has to be the date, not just that you issue, but you have till that date to upload them to the Federal Clearinghouse database. And that gets a little involved going back and forth between the organization and the auditor approving different things. That takes a couple days, so don't wait till the last day to do that. But because this might come as a surprise to many organizations, the government has granted us a little extra time to get this taken care of. So if you look at the third bullet point, if you're a June 30 year end, your single audits were due March 31. Now you have until September 30 of 22 without being considered late. And that extension applies whether you have COVID funding or not. So even if you've always had a single audit, you have no new programs, no COVID programs, you still get the extra 6 months. So you have till September instead of March if you're a June year end. So the bad news is you might have tripped yourself into a single audit. The good news is you get a little more time to get it taken care of because it's going to be a lot of people's first time doing this, and they might need a little extra time to figure it out. So with that,